Hi, and welcome to our 2023 market outlook entitled The Art of Investing. My name is Ryan Grady. I'm an investment advisor representative here at Paradigm Wealth Advisory.
And I'm Sara Gill, also an investment advisor representative here at Paradigm.
And we're so excited to bring to you our 2023 market outlook, so let's get right to it. All right, so as we said, our outlook is entitled The Art of Investing. So I want to talk about two different artists. One many of you will be familiar with. I know he's synonymous with my childhood and watching PBS channel, and his name is Mr. Bob Ross. Bob Ross's legacy is certainly one that we all know very well. In fact, Bob's company, Bob Ross Inc., makes more now in 1 year than Bob did in his entire lifetime while he's alive. So quite a legacy for Mr. Bob Ross and his happy little trees. Our second artist, Mr. Jay Powell, Chairman of the Federal Reserve. He is also an artist, though many of you may not have known that, except he does not use paintbrushes and paints. He uses interest rates to paint what he hopes will be a happy little economy. Now, what will his legacy be? Only time will tell. So, with that being said, let's take a look back at 2022. Now, to do that, we want to really go back all the way to 2020, right? Now, in 2020, we remember the pandemic began, right? And we saw a contraction back in March of 2020. The market took it on the chin as businesses were shut down, as we had a crisis and pandemic on our hands. Well, there was a policy response that led to recovery, and that was a much necessary policy response. Rates were kept low, an easy money policy took form, and the market recovered. In fact, very quickly, a V recovery took place and ended up being quite a year in 2021 expansion, which led to inflation as we headed into 2022, which led to yet another policy response. But this time there was a tightening of the money supply, and there was a increase in interest rates, which led to contraction. Many of us know the tough year that 2022 was. Now, looking ahead, we think that there is an opportunity for normalization and, dare I say, recovery for 2023, but more on that later in our presentation. So if I had to sum up 2022 in one chart, it would be this: the fastest rate hikes in history, to the tune of going from 0.25%, 0.25%, all the way to 4% in less than 1 year. I believe it was somewhere between 6 and 7 rate hikes during that time. Again, the fastest and most aggressive rate hikes we've ever seen. So, Sara, what impact did that have on the market?
So what happened? These rate hikes led to an everything bear market. The fear of the rate hikes, along with the rate hikes themselves, were a catalyst for a broad market sell-off in 2022. The stock and bond markets were propped up in 2021 by an overabundance of stimulus. Both of these markets came back to earth as rates moved north. You can see here the S&P 500 was down almost 20%. The NASDAQ was down over 28%, and even the Ag Bond Index was down over 14%. And although we don't traffic in Bitcoin, the hype around that came crashing down in late 2022 with a 65% correction. The result of this everything bear market was the worst single year in 60-40 balanced portfolio history. This is the portfolio that's widely considered to be the traditional retirement portfolio. Shown here is the rolling 9-month returns for the 60-40 portfolio over the past 3.5 decades. The downturn experienced within the markets during 2022 led to a negative 16.38% return for 60-40 investors. But Paradigm was prepared for it. You might recognize Buzz Lightyear here from our Market Outlook presentation in 2022. Back then we saw an overheated economy, inflation coming, Now, this doesn't mean that clients avoided all losses, but our conservative approach largely helped us to avoid the low lows that we saw in 2022. Now I'm going to hand it back to Ryan to turn our focus to the year ahead.
Thank you, Sara. So, sticking with our paint theme, right? And if we remember paint by numbers, a lot of people ask us, hey, what is the one key metric that we need to focus on when we're looking ahead? And our response to that is there really is no one key metric. I remember when watching Bob Ross paint, and as they started to put paint to a pad and seeing the strokes come out, I thought to myself, what on earth is he painting? It made no sense. But then as each color, each stroke came into play, all of a sudden a log cabin and trees and mountains appeared, and lo and behold was a beautiful picture after all the painting came out. It was really incredible. And it's the same type of discussion here. No one metric tells the story. You need to look at a number of different data sets to really understand. So let's do that right now to get a clear picture of where we're headed. So first thing, the economy. What you want to really focus on here is what is the main driver of the economy, and that's you and I, that's the consumer. Almost 70% of the economy is driven by the consumer. Well, with that being said, relatively, how healthy is the consumer? You can see here, household debt service payments as a percentage of disposable personal income, the consumer's in relatively good shape. So if you compare that back to 2008 and you can see that peak there, the consumer is in relatively good position. So what does that mean? Well, consumer drives the economy and the consumer's in reasonable shape. We believe while recession is likely, it isn't likely to be so severe or as severe as some people are saying. Next, let's look at fiscal policy and finally some prudence, right? While spending has not stopped, it has at the very least slowed down, right? And that is a good sign. So stimulus was needed 2 years ago, as we talked about when the pandemic hit, and they left that faucet open for quite a while, but now that is beginning to slow down. Finally, let's look at for monetary policy, all right? That we also see a tightening of the money supply. Now this is the kind of other side of the coin, because tightening of money supply typically correlates to a negative return in the market. So tighter monetary policy does give us a little room for caution there and to be wary of that.
So the next color that we're going to take a look at in our market outlook painting here is corporate earnings. Now, this is a chart some of you might be familiar with. We've used versions of it throughout the past year or two. Pictured here in dark blue are forward-looking earnings of the S&P 500, and in light blue is the price of the S&P over the past 10 years. Now, these two lines generally tend to move together, but as you can see, the prices started to drift far above earnings and continued to drift further and further. This is noted in that section highlighted in yellow here. With the market correction we saw over the past year, you can see prices return to and even exceed earnings, which indicates a far more attractive price point than we've seen in recent years. Now, while earnings are likely to decline slightly in the first half of the year, earnings growth appears to be stable and should provide steady growth in the latter half of 2023. Next, we'll take a look at valuations. Valuations were propped up by mountains of central bank stimulus and are beginning to look relatively attractive again, now that that stimulus has been withdrawn. For the first time since 2019, we're seeing S&P 500 forward-looking PE ratio below the long-term average. Last year's downturn has provided attractive buying opportunities for long-term investors. Now we'll take a look at investor sentiment. Here you can see consumer sentiment charted over the past 50 years. Looking back to November 2008, we can see that consumer sentiment was at its lowest point since the early 80s. However, the subsequent S&P 500 12-month return was over 22%. Following the start of the pandemic in April of 2020, consumer sentiment was at its lowest point in almost a decade, and the subsequent S&P 12-month return was almost 45%. This goes to show that investor sentiment is often the inverse of the path of future returns. While the past isn't a guarantee of the future, it's consistent, and with consumer sentiment at the end of 2022 at its lowest point in the past 40 years, this chart suggests positive long-term returns. Now that we reviewed the economic and market metrics that help us to paint our market outlook, the last color to be added to our painting is a legislative measure. Congress passed the Secure 2.0 Act in late December of 2022. Listed here are a few important changes outlined within the Act, but I just want to take a minute to highlight a few that we think are most prevalent to our clients. The first of which is required minimum distributions. So the age at which you must begin to take your required minimum distribution, our RMDs as you'll often hear us refer to them, has been moved from 72 to 73 for 2023 and will bump up to 75 in the year 2033. And the penalty for not taking your RMD has been reduced from 50% to 25% and in some cases 10%. The second item that I want to bring to your attention is catch-up contributions, which got a boost. In 2023, if you're at least 50 years old, you're eligible to contribute an extra $7,500 to your IRA or 401k. In 2025, this amount will increase to $10,000 for those ages 60 and beyond. Additionally, catch-up provisions will be indexed for inflation moving forward. So these legislative changes create some potential planning opportunities, not only in 2023, but in years ahead as well. And with that, I'm going to hand it back to Ryan to conclude our presentation.
So once again, we talked a lot about the different metrics that help us paint a picture. And to revisit that again, it's just very important to remember there is no one single data point that should drive an investment strategy. So here at Paradigm, we certainly want to take that holistic approach and look at a number of different data sets so that when done, we get a clear picture of where we're at and where we're headed to drive our investment strategy. So on that note, where do we see things headed? How do we invest from here moving forward? So a couple quick points there. Number one, high quality intermediate duration bonds, right? So we've used short-term treasuries here during these times of interest rate hikes. We now feel it's a time to extend that duration. So good time to buy intermediate duration bonds now that rates have risen. Not quite yet time for what we refer to as high yield, or some people call them junk bonds, as we do feel there is still a risk of default. So some changes in the portfolio you'll see there. Still talking value over growth within the US. So higher interest rates favor the real economy over those growth, those technology stocks that we saw that were the darling, as we said, of the stock market these past couple of years. Also, long periods of relative underperformance. Value has underperformed vastly this past decade when looking at its comparison to growth. So we think that they are still cheap by comparison. So international, again, very similar story. We do believe we're at an inflection point. Overseas equities are due. They have, again, vastly underperformed in comparison to US equities, especially emerging markets. They become more attractive as China comes out of their COVID slumber as well. So finally, commodities, right? Higher base inflation environment, that equals a continued opportunity for gold and commodities, a place for us to park some of our assets. So a lot of information. Would love to sit down and talk to you. Please don't hesitate to reach out if you have any questions how all this information relates to you and your personal situation. So thank you again for joining us. Take care, stay healthy, and we'll see you in 2023.